Well, we're live here on YouTube, so good afternoon here from Cheltenham, Gloucestershire. Gorgeous, gorgeous day today. I'm Paul Archer. I'm looking forward to giving you 20 minutes or so of some live mortgage updates for you. Keep you at the cutting edge, which is the whole point behind these CPD kind of live streamy things that we're doing. Lovely, lovely day out there today. Be out in the garden this morning doing all my scripts and things because I'm recording after this as well, and we'll throw those onto the YouTube channel and onto the boot camp as well. So okay, update for you before we get on to our big topics today, because I want to take a look at rental coverage and protection. Got some issues around protection at the moment I want to share with you. A little bit nervous ones, really, because a lot of people think protection's dead easy. It's not. If you get it wrong, you can be sued on. So you've got to be very careful with this sort of thing as well. And we'll come on to that a little bit later. So mortgage market. So yeah, good things going on, really. Good things. Survey by TML on brokers. They're frazzled, busy, hectic, run off their feet. The average broker now, mortgage broker, mortgage advisor, call them what you like, is really, really busy because of what's been going on in the marketplace. And long may it last, is what I say. The first-time buyers are coming back in now. The lenders are bringing in their 95% mortgage products. The early ones were bringing in some ridiculously stupid fees. I spoke about that last week. But the later ones are starting to drop the fees. Maybe they listen to my podcast. I don't know. Probably not. But the government-backed stuff's coming in now. The vanilla lenders, the Santanders, that kind of thing, are bringing in their products now. 2 5-year fixes around about the 4% mark for a first-time buyer, borrowing at 95%, very low fees. I mean, what's wrong with that? That's pretty damn good as far as I'm concerned. They're making a bit of a margin, quite a bit of a margin. I don't think they have to pay the government a bit of a fee for this, so they're probably, well, they're getting that fee through the margin, because if they sort of lend out at, say, 4%, borrow, the money comes in at, say, 0.5%, they securitize these things as well. Of course, the wholesale market's much, much cheaper. They're making a good margin, 3.5% or so, keeping their costs down because they're closing all their branches. So they're doing all this stuff via brokers. So all they're paying is proc fees at the moment and a salary for a BDM, plus the company cars those guys jump around in. Of course, the ones that get it by doing video, they don't need company cars, but there we are, we're going to talk about that. So good news, I think, for the mortgage market. What else has been going on? One worrying factor for you is inflation. Inflation's beginning to surge. You see all the signals coming through, quite concerning as well. CPI, of course, the measure here in the UK, is low, and it's targeted at 2%. It's creeping upwards. We went out to a garden centre at the weekend, Shelley and I, and there was no special offers at all anywhere. And everything was double the price from last year. Because everyone wants to populate their gardens now, of course, because nobody's going on holiday this year, are they? Or at least the over 40s aren't anyway. The under 40s don't really worry about it so much. But so the over 40s are staying in their gardens or going down to Cornwall. But Cornwall's full, so there we go. But prices are trickling upwards. We also went to buy some patio. We went to buy a patio heater online last night, and they're 300-400 quid, whereas last year they were a couple of hundred. So prices are starting to come up. Tesco's have no bog offs or special offers anymore. Prices, it's a supply shock. You see, we all said it would happen with us coming out of this pandemic. Supply shock. You can't suddenly supply things. Shelley went to Home Sense this morning to look there. Nothing in stock, she said. There's nothing going on in there at all. Anything is there is really expensive. So beware of inflation. So think about that with your customers. Think about 2 5-year fixes. Think about fixing the mortgage rate, because inflation, of course, will be combated with interest rates. As things start to go up, we still work with a monetarist kind of chance of the exchequer. So anyway, that's that for you. Let me give you a topic now today. Let's get on to some of our topics. And one topic I want to talk about today, I hope you're well, by the way. I'm sure you all are. I hope you're well and thriving and all those good things, because life's pretty good at the moment, isn't it? With the sun shining and coming out of this pandemic, at least here in the UK anyway. Around the world, it's not so much the same story. Let's talk about buy-to-lets. What I want to talk about now is the rental cover on buy-to-let mortgages. Now, we can talk here about holiday lets or buy-to-lets. Holiday lets are coming back on stream now, of course, really popular. But of course, holiday lets use the same concept really when it comes to buy-to-let. So we're talking about BTLs, buy-to-lets, not bacon, lettuce and tomatoes. And we're talking here about rental coverage. A lot of people ask about this. particularly those doing CMAT, because CMAT kind of covers it, really. Not in huge amount of detail. Of course, people are generally new to the topic in CMAT. People are quite confused about the whole thing. Now, the point about rental coverage is it's a relatively simple concept if you break it down, really, because you have a property which you want to buy on a mortgage, of course, and this property you're going to rent, so to let. There is the sign that goes up, not to buy. Now, because the lender wants to take that into account as security, it doesn't really care about your own income. Lenders on buy-to-let mortgages don't give two hoots about your income. They want you to be earning because they don't want you to move into the house rent-free in case you get skint. So they want you to be self-sufficient. They don't really care about your income. What they do care about, though, is the rent. They care about the rent, and they will lend you an amount of money that's geared around a rental coverage. Typically, I mean, some of the percentages here, you might get 145% rental coverage. If it's a limited company loan, you might get 125% rental coverage. Basically what that means is they will lend you on a mortgage a percentage of the rent that you're going to get. So the maximum mortgage they'll lend you is 145% of the rent you're going to get, and the rent is calculated by the surveyor. She goes in, she calculates obviously the mortgage valuation, but also the rental valuation per calendar month. A bit like Homes Under the Hammer, isn't it? Per calendar month. And they give you the rent that property is expected to get, and then they'll lend you a maximum of 145% of that rent. Pretty much that's the way it works, really. So as you can appreciate, therefore, the rent itself could be, 1,000, but of course, 145% of that is a lot more. So they'll lend you that sort of money, and they want to be careful that you're going to not, you're going to have periods where there's not going to be rent coming in, or there might be a period where there's no tenant there or whatever, or there's other costs involved. So they're very, very wary as to lending you huge amounts. So the best way to illustrate this is to give you a calculation. And you can start to see how it works and get it right in your own head, because it's pretty much one of these twist your melon man things, as the Happy Mondays sang about in the 90s. Twisting your melon man. I don't know where Bez got that phrase from, or was it Sean Ryder or one of the others? But let me give you an example and then we'll calculate it. First of all, you need a calculation to be able to do this. You need to be able to work out a sort of a factor to work it out with. So what I'm going to do is put that up on the board for you. Now, the factor for maximum loan, we'll call this one here, maximum loan. The factor that you use is a calculation. What you do is you take the rent, you divide it by the cover, the rental cover, and then you multiply that by 12 divided by the rate. So that's the calculation that we use. Now, obviously, computer systems do this for you, so you don't need to worry about it. And in the CMAT exam, you're not going to get that, but this just helps you to understand how it all works, really. So that's the calculation that you use to work out maximum loan. So let me give you a example of one that we can use just to sort of show you how this works. So what we've got here, we've got a couple buying a property which is achieving, so here's an example of one, which is achieving a rent of £650 per calendar month. So that's the rent. The applicant's an individual borrower, so it's not a limited company. Now, limited companies tend to use a lower rental coverage, whereas individual borrowers tend to use a higher rental coverage. And that's pretty much it, really. They're taking out a fixed mortgage, fixed. This one is a 2-year fix. And the interest rate on the 2-year fix is 3.5%, say. Just an example for you. And that's pretty much all we need. Now, what you do need, of course, is to be able to work this out. So let's do that for you and see how we get on with this one. So let's get the blue pen. So first of all, then, the calculation requires the rent, which is £650. There you go, £650. Divided by the cover. Now, the cover we're using here is 145%. 145. There you go. Multiplied by 12, divided by the rate. Now the rate's 3.5%, but it's not, because to work out rental coverage, lenders have to stress test this one. They have to use either the stress rate or a higher fixed rate. Often if it's a longer term fixed rate, say 5 years, they'll use that fixed rate interest. But if it's a low fix like this 2%, the 2-year fix, or it's a variable, they'll use the stress rate. Remember, the stress rate is what Possibly it could go up to if things got really bad. So that's what they use. So in this example, we'll just use a stress rate of 5.5%, because 5.5% happens to be the lender's stress rate, which you're often given if it's a calculation to do. And what you do is you work that out. If you've got a calculator, you can do that. So I'll grab my calculator here. Simple old calculator, remember. And I'll work this one through. So £650 divided by 145, here, pop that in the calculator, times by 12 divided by 5.5% gives me, here we go, £97,805. There you go. Now, obviously, I just calculated that, easy enough to do. But as you can see there, the calculations helped you to understand it, because you've got here a mortgage of £97,000 is the most they'll lend on £650 per calendar month. So, okay, it's not a huge amount, but that's the maximum they'll lend on an individual basis, because of the stress rates 5.5% and the cover is 145. Now, if you were to borrow on a limited company basis and maybe have 125% coverage, you'd find that figure would get higher, because you're doing 650 divided by 125 times that. So the mortgage gets higher. So as you can see, the monthly payments on that, which would have been worked out, of course, on interest only, that's the most mortgage you'll get. It's just a calculation, that's all. It's a calculation. We could do some more, might do some more in another video for you. On our boot camp, we do go into these in a lot more detail, but that gives you an idea of how coverage works. And that's how they calculate buy-to-lets. Hope that's been useful. There you go. Hope you enjoyed that one. Just a quick sort of update for you, really, wasn't that one? Interesting calculation, that wasn't an interesting calculation. Okay, let's get into a couple more topics for you then. I think we've got time to go into another topic, which will be a lot of fun for you. What I want to do now is take a look at some life assurance stuff. So let me get rid of this first of all, so that you can capture the whiteboard in a bit more detail. Yeah, you won't get this sort of calculation in a CMAP exam, but in the advanced mortgage paper you certainly would do. So you would need to know about all these things in the advanced mortgage paper. And we do teach about this, but on the RO7 or the CMAP diploma, which the IBF do as well. They're all good exams to have. You've got to think about specialist mortgages. You need some qualifications, really. So let's get into protection now. I've got a bit of a problem to share with you now, which has come to light recently. I've been working with a lot of clients. And by the way, this one is entitled The Case for Single Life Plans. Here, this one's called The Case for Single Life Plans. Single life. I've been working with a lot of clients recently, helping their mortgage advisors sell more protection. We do mostly selling skills or persuasion skills, because life assurance and protection, critical illness, has to be sold. Now, problem we've got is a lot of people who are dealing with this product area are CMAP qualified, and CMAP hardly covers the topic properly, really. There is some changes afoot, which I'll share with you in a second. But what you're finding then in this marketplace is you've got a huge amount of first-time buyer activity going on now, haven't you? You've got the young couples all looking to buy property. There you go. And we've got a couple here, stereotypical couple. It could be opposite sex, of course, it doesn't really matter. But young couples looking to buy properties. Unmarried, so no civil partnerships, anything like that. And that's predominating the marketplace now. And with this 95% lending coming in, you'll find a lot of people, first-time buyers, will come back in. A lot of single people will buy in lower price areas, but in higher price areas, people tend to club together. People buying together, couples, just partners, whatever. So they can get a bigger mortgage and a bigger property. And they take out a mortgage, a joint mortgage, or whatever that looks like. And they get cover, they get protection, because protection advisors will swoop in and sell them the cover. So you're finding an awful lot of joint life cover being recommended. It tends to be the default for a couple, a married couple, yeah, but even an unmarried couple, a young couple living together, maybe going to get married, maybe not, doesn't really matter these days, does it? But they tend to go for this sort of default joint policy. And I don't know why that is. This is the worry. Is it because it's cheaper? Is it quicker? Is it less paperwork, less admin, less hassle? Is it just a knee-jerk reaction? You go joint, joint, joint every time there's a joint mortgage. And that worries me really for three reasons. And I'll share these with you. Number one reason is portability. So there's three big reasons here for you. Let's put them over here for you. Let's get a different pen. The portability. Yeah. Now, portability or flexibility, call it what you like, it has gone, because if these people have a joint life policy, they do go their separate ways, and we mustn't encourage that, because they're all loved up, aren't they, in some of these people, and you don't want to encourage any sort of split up notions. But if they do go their separate ways, a joint policy tends to get cancelled, and that's not a good thing. Whereas a couple of single policies would certainly go their separate ways as well. The other one, of course, is death, premature death. If the policy does pay out, which of course these things are designed to do, then the policy stops, because it does. The policy stops, therefore the people aren't covered anymore, and to get insurance they have to go reapply. They may be still young, so it may not be a problem, but that's a big issue. But the third big issue is taxation. And people don't really appreciate the impact of this. It may not have an impact, but it might, and that's the consideration that you need to have. Now, let me explain how this works. As you can appreciate, of course, when somebody dies, which what life insurance deals with, they have a potential inheritance tax liability. I say potential because there are a lot of limits now, and there's main residence exemptions and annual exemptions and stuff like that. But potentially, you see, when somebody dies, the value of their property falls into their estate on death. Now, it does depend, of course, on how the house is owned. We sneak a property down here. Let's put the property there for you. It does depend on how the property is owned. If it's joint tenants or tenants in common, it does change. If it's tenants in common, of course, a share of the property will go into your estate and then get inherited, and that could, of course, enhance things. But you see, a lot of people don't know that even if the property is owned joint tenancy, a nominal share goes into your estate. So if this property is owned joint tenants, which of course means on death it goes to the other person automatically, the revenue take half of the property and nominally put that value into your estate on death. Not a lot of people know that. They give it a discount on market value, but they will put a value in there, even though it's gone to the other person automatically. So that's the first thing. Now, in addition to that, here's the rub, the life assurance policy that's set up, joint life policy, again, half of that, although all of it goes to the person that's surviving, half of that also goes into the estate, a nominal figure, a token figure, call it that. So you've got these two token figures, half of the property value and half of the life assurance value, nominally going into the deceased estate. And think about that for a second, because if you're in a high price area, so, I mean, the government's new 95% mortgage scheme ends up to 600,000, I think it is, a huge amount of money. So you could have property, say 500,000, with a mortgage of say 400,000. So suddenly you've got 250 plus 2, you've got 450 grand nominally going into the deceased estate, which can cause an inheritance tax liability. Not a lot of people know that. And of course, this then is going to be inherited by the family. Unmarried couples tend not to have made wills. They should do, of course they should. But invariably they're unmarried, so the law of intestacy kicks in. The money therefore goes to the next of kin, which probably is the parents. So the parents have got an IHT bill to pay. So they're going to get well upset about that. So it's big implication, this one. Now, of course, the parents might decide, well, who gave that bad advice? And they might sue you. Don't get these claims management companies now hovering around like vultures looking for the next big topic, aren't they? Because they ain't got much work at the moment. So they will pick up on this sort of thing. I can see it happening. And therefore you'll be sued accordingly, and you don't want that. All because you gave the wrong advice. Think about that. That's big. Now, you may not have known that because CMAT never taught you that. CMAT syllabus didn't go that far. It mentions inheritance tax and stuff like that. Of course it does. But the answer is quite clear. I put this in red. The answer, as you can appreciate, is 2 single policies. You want 2 single policies rather than the joint policy for unmarried couples. Full stop. Make that your default. Here, obviously, you can put them into trust. Of course you would. So that the money goes to the other party on your death. Of course you would want to do that. And this kind of solves all the problems, really, because you've got money going into each other. There's no half policy, of course, to go into the estate. Money goes to the other person to pay off the mortgage. On portability side, they go off their separate ways anyway. On death, there's another policy remaining, and the taxation issue is at least halved anyway along the way. And I think that's a really good thing. You could do life of another. Life of another is where you set up a life policy on the life of somebody else. You own the policy and it's somebody else's name, which you can do as well. That's an option, but they've pretty much died a death in the 20th century, really. Excuse the pun, died a death. They tend to be pretty inflexible and not really what we recommend. Nowadays, we tend to go for the trust version. So that's just what you should do, and hopefully I've explained why. Did you get it? I'm sure you understood. Did you know that? Probably not. Not a lot of people do. Did you learn about that in CMAP? No, you didn't, because people think that CMAP is enough for protection advice, but it's not. How wrong could you be? They're boosting it. They're increasing. Later this year, the LIBF, and brilliantly so, in August, are expanding the protection side of the syllabus, and rightfully so. But if you want to get yourself a professional qualification, you can get, for example, the CERT Pro from the LIBF or the RO5 from the Chartered Insurance Institute, which you should do. If you're giving advice on protection, critical illness, all that stuff, you should do this, because it really will arm you with the technical knowledge that you need. So an advanced qualification is essential, and of course you can talk to me if you want some help with that, as you can appreciate. But we'll do a lot more videos on that later this year. We're going to really push for the protection side of things this year. We're going to launch a boot camp on the protection exam, audios and videos and all sorts of things to help you. No classroom courses, by the way, because they are a thing of the 20th century too. Packing people into a classroom, which is hot and stuffy, with some tutor at the front lecturing away, is a thing of the past. I'm sorry, but it is. Now, ours will be online. It'll be very cost effective and will help as many of you get your advanced protection qualifications as possible, because at my age, I'm 57 now, my living has been with the mortgage industry all throughout since the early 80s. I want you to look after your people properly. I want your people to get the right advice. And 2 single policies, it's the same as one joint. It's the same price. It's only a couple of quid more. And people would be surprised about that. So there we are, my little rant over protection. Hope you found that interesting and useful. I think we'll pack up now on this live stream. We'll be running for about 25 minutes. Hope you found it useful. Some good topics there as well. We're going to carry on recording afterwards, and I'll post those videos onto the YouTube channel. As always, of course, the boot camp, people get all this on HD, plus loads more videos as well. And we're starting our boot camp today. We've got our Spring 2 cohort kicking off today. Still got 2 spaces if anybody wants to jump in over the next sort of 4 or 5 days. So we'll let you know, 25 people max, you see. We've got an induction happening this evening at 4:30 on video. So I rock up on Zoom and people all come online, and we'll help you through the CMAP. Remember, my job is to get as many people into this mortgage industry as possible and treat them well, look after you, so you become really good mortgage advisors and look after the sector that's paid me out well over the years. So that's it from me. Hope you have a great week. Paul at paularcher.com if you want the web address, but it's all down below, isn't it? And you can subscribe and all those good things. We'll see you next week.